Today we are analysing Verizon versus AT&T to see which is the better company with a high yield for your portfolio. We'll look at their dividend safety, we'll also jump into their supporting financial metrics, as well as comparing their performance with each other over the last few years, and we'll see what the institutions themselves are doing, as well as taking a look at any insider buying and selling. And don't forget, we will run them both. To get to their intrinsic value, we want to see which one has a larger margin of safety and which one Wall Street are forecasting has the largest upside over the next 12 months. So let's take a look and start off with Verizon Communications. Now this is up around 9% over the last year. It is trading towards the mid to upper end of the 52-week low. It has a yield of 6.59% and a forward PE just below 9. Now, if you've been holding this over the last 10 years without reinvesting those dividends, you would be down around 14%. Now, comparatively, when we take a look at AT&T, this is down around 7.5% over the last 12 months. Over the last 10 years, well, you would also be down, but this time 36%. And we can see it trading in the mid-region of the 52-week range, with a yield pretty much similar to Verizon of 6.54% and a forward P sitting under 8 at 7.68. So let's take a look at the performance of these two high yielders over the last few years. We can see over the last year, Verizon has significantly outperformed AT&T, up 15%. That includes those dividends reinvested, whereas AT&T, even after reinvesting dividends over the last year, you would be down negative 1%. Now, when we extend that to the last 5 years, we actually see it is a very poor investment. Both of these, AT&T, even after reinvesting dividends, you would be up only 2%. Verizon, you would be down negative 12%. But always remember that past performance is never an indicator of future performance. So whilst they were very terrible investments over the last 5 years, this may not be the case over the next 5 to 10. We can also now take a look at essentially insider buying and selling. We have put the ticker symbols for both AT&T and Verizon over the last 2 months, and we only essentially see some sales for Verizon, and we see in fact the group CEO on 2 different occasions has sold around 39,000 shares at a price of just under $41, and we can see in total this gave her around $1.5 million. Now, do bear in mind though that investor or insider selling isn't necessarily a bearish signal. They can sell for many different reasons, and we note on one sale that the price has gone up around 0.61%. On another sale, it is now around down 0.55%, but always good just to take a look at this information. Now, in terms of institutional ownership, starting off with Verizon, we see around 62%. And we see around just under 11 billion worth of sales by the institutions over the last 12 months, with more buying 16.74 billion over the same time period. And we also note in the more recent quarter, Q4, institutions have been buying more Verizon shares to their portfolio. Now, when we compare that to AT&T, 57.1% institutional ownership, and we see around 5.6 billion worth of sales, with a significant amount more buys by the institutions, 22 billion, in fact around 4 times as much. And we also note in Q4 more buying than selling. So both stocks are very similar, roughly a similar institutional ownership, with the same trend of more buying by the institutions than they have been selling, as well as the more recent quarter of Q4. Now, just to also let you know, we have essentially released our latest free weekly newsletter article. If you want to gain access to this, as well as all the other articles that we do have here, click on the pinned comment below and you can gain instant access. So let's take a look at the dividend safety and the financial metrics. Now, for Verizon, we have a dividend safety score of 70, market cap 170 billion, a mega cap company. In terms of those recessionary metrics, well, last recession, 07-09, they increased the dividend. They had above average growth at negative 1% versus the S&P's negative 12, and they also outperformed the S&P negative 38 versus the S&P's negative 55. Dividend growth. Now, on this channel, we do try and essentially advocate that we want a minimum of 4% year on year just to keep up in line with inflation. We have seen their latest increase over the last year, as well as over the last 5 years and last 20 years, come under that 4%, something just to bear in mind. But we do like to note that they have increased their dividends for the last 17 years, and over the last 40 years they have been paying a dividend without a reduction. Now, in terms of dividend yield theory, for those that are new to this theory, it states a company is undervalued when the current yield sits above the 5-year average. We have our first sign of undervaluation, but we also see a sign of undervaluation with the forward PE 8.8 below the 5-year average of 10.2, but it is important to note that we don't look at these models in isolation and conclude towards the end. We also can see the communication SEC-P is much higher at 17.9. As always, we draw your attention to the free cash flow payout as earnings is susceptible to manipulation by management through accounting, with below 70% the preference if you want to be industry specific for telecoms. Now, 2022 is what we would call a red flag indicator. They paid out more in dividends than they generated in free cash flow. On the more positive side, 2023 it did drop to 86%, and although that is above the 70% target, we can see 2024 it is expected to come down to 60%. Free cash flow per share, we can see it hasn't been the greatest year on year, very inconsistent. We note the large drop in 2021, and it has, however, picked up since then. 446 is expected in 2024, which is nice. That is some strong growth from the 2023 $3.07. In terms of sales growth, well, we do see it very inconsistently, especially when we want that steady moderate growth of 3 to 7%. Also important to note, last year, so 2023 full year accounts, they did have a negative 2% drop to their top line. And when we look at this numerically, we can see, whilst it has increased from 127 billion to 134, if you take into account inflation in real terms, the revenue has not been increasing. Shares outstanding, well, what we love is when companies do essentially share buybacks, returning excess cash to investor pockets as you get an increase in terms of how much you own of the company. What we note here is the opposite. They've diluted your position and they've increased those shares over the longer term. Now, when we look at the ROIC, realistically, I want to see 10% or more, and this would look pretty decent as a potential investor as they have managed that over the last 10 years. The last 2 years at 10% also looking very strong. As always, 10% or more gives us that faith that management are able to effectively allocate their capital. Now, operating margin, nice to note the operational efficiencies. It has increased from 16% in 2014 to 23%, and that is above that 14% level. So no worries on their margin. Free cash flow would be nice to be a bit more consistent, but over the last 2 years, it is above that 7%, so no real worries, but again, you could keep an eye on this given how close it is to the 7%. Finally, and one of the most important for these telecoms that pay high yields, are the net debt to EBITDA metric, earnings before interest, tax, depreciation, amortization. And this essentially shows us the number of years it would take the company to pay off all of their debt net of cash on hand, and signals, one, the balance sheet strength as well as two, the dividend safety. So below 3.5 is what we want for telecoms. 3.34 is below that in 2023, expected to be a little bit lower in 2024, so no real worries there. Again, you can keep an eye on it as one of those metrics, but so far the dividend for Verizon does look to be reasonable and safe. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And whilst when we do deep dives on the channel, we do run through every single one of these models, today let's just get straight to the intrinsic value. And this for today's episode comes out at $44.81. Now what we're looking for here is we want to start off with a margin of safety of 10%. And we use that if it meets the 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Now we can see it isn't too far off that, around 40 cents. So we do believe that Verizon right now is trading with a margin of safety of 10% based on our estimates and judgments. In terms of Wall Street, well, their forecast over the next 12 months is a price target of $44.71. And as we can see, there is around 10% upside attributed to that. So let's go and compare that to AT&T. So when we take a look at AT&T, we can see the dividend safety score is 10 points lower at 60, so it is borderline safe. Market cap 121 billion, it is a mega cap company. In terms of those recessionary metrics, well, they did increase the dividend in the last recession. They had above average growth, and they also outperformed the S&P. In terms of dividend growth, well, not the greatest news if you are a dividend investor or you do solely purchase these for the high yield, as over the last 5 years, given they had a dividend cut, we can see on average it has dropped by negative 11%, and over the last 20 years, 0% increase year on year, hence why we can see 0 years of consecutive increases. Now, in terms of dividend yield theory, we can see here a sign of reasonable valuation, 6.51, not too far off the 5-year average of 6.75, and we know the forward P at 7.7 does sit below the 5-year average of 8.5, And when we look, similar to Verizon, it is well below the communications sector P of 17.9. Now, in terms of the free cash flow payout, much better than Verizon, as we can see. Not only has it been decreasing, but 2023 at 39% and 2024 at 45% is well below that 70% for the telecoms industry. In terms of free cash flow per share, again, very inconsistent. Nonetheless, though, however, unlike Verizon, this has been increasing over the longer term, but it is important to point out in 2024, it is expected to reduce down to around $2.44. Sales growth, now we can see they did have that spin-off, so therefore we do note that is one of the reasons why we see the sales growth drop. But in their more recent year, 1% increase, not the greatest, and below that 4% inflationary rate that we always target. And we can see, again, not a great comparison given that spin-off, but it has reduced from 132 billion to 122. Shares outstanding, very similar to Verizon. They do dilute your position, although at a quicker rate, in my opinion, from 5.22 billion to 7.26. So always be aware of that as a shareholder or even a potential shareholder. ROIC, below that 10% level that I personally look for, not too far off it, as we see over the last 3 years between that 8 to 9% level. Operating margin above the minimums of that 14%, and whilst it has decreased from 2021's high, 21% is still very healthy. And the free cash flow margin actually looking very strong in comparison to Verizon. 17% in 2023 for this industry is very strong and attractive to potential investors. Net debt to EBITDA, a very similar story to Verizon. It does straddle around that 3.5 level, 3.13 in 2024 expected, so a little bit lower than in 2023. So whilst we do see the borderline dividend safety score, in my opinion, based on these metrics, it does look to be healthy and no real worries yet on this information. In terms of the intrinsic value, and don't forget you can always grab a copy of this model if you want to get to the intrinsic value or the acceptable buy price of companies in your own portfolio or in your watch list by clicking on that pinned comment below. Now, a margin of safety of 10%, as we established, meeting the 3 criteria, would be a buy up to $18.38. If we keep extending this till it gets to the current trading price at $17.36, it would give you a 15% MOS level. At 20%, it isn't quite there yet, so we see a 15% margin of safety for AT&T based on today's trading price. How about Wall Street? Well, as we can see, they do have some significant upside, 22% for AT&T at essentially a forecasted price of $20.89. And just to refresh your memory, for Verizon, we saw a 10% margin of safety with upside of 10%. Therefore, in today's episode, for those looking for a high-yielding stock to add to their portfolio, we do believe that AT&T does look more attractive. 1, in the margin of safety that you can get, as well as 2, the upside that Wall Street are forecasting. As always though, do let me know your thoughts in the comments below. Is this one you are looking to add to your portfolio? Maybe you hold it and are considering adding more. Let us know. Personally, they aren't ones that I will be adding right now. I do see a lot of better opportunities in terms of growth. However, this could be one for those investors who just want the yield at around 6 to 7% level. Let me know as always, and if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.